And a very happy start to the week to everyone listening. A new earnings season is officially upon us.
It is. It feels like the starting gun has just fired.
It really does. What is Wall Street expecting? Well, the banks are kicking it all off, and we have all the analysis right here for you. Cheers to everyone tuning in.
It's great to be back. And you're right, the gun has fired, but the pressure is definitely on. It's Sunday, January 18, 2026, and the stakes, they just could not be higher.
You know, I feel like high stakes is a phrase we throw around almost every quarter.
It is, yeah.
But looking at the valuations right now, this time it feels mathematically true, not just hype. We're looking at an S&P 500 trading at a price-to-earnings ratio of what, about 22.2 times?
22.2. That's for the next 12 months, and no, that is not cheap.
Not at all.
For context, the 5-year average is closer to 20 times.
Right.
So we are historically expensive. The market has basically priced in two very, very difficult things at the same time. A soft landing for the economy.
Meaning no recession.
No recession and a massive reacceleration of corporate profits.
So basically priced for perfection.
Perfection. There is zero, and I mean zero, margin for error in these stock prices. When you pay a premium price, you expect a premium product.
Right.
If a company comes out and says, we did okay and next year looks fine, that is just not enough to justify a 22x multiple.
Yeah.
And that's really the theme of today's Deep Dive, the crossroads of valuation and execution.
Investors are saying, okay, you promised us growth, now show us the money.
Exactly.
And the banks were the first to step up this past week. It felt a little confusing, I think, for the average investor. You see the headline, earnings beat, but then you look at the stock ticker and it's in the red.
A classic. Sell the Newsweek. We have this fascinating stat from the first few days of reporting that it perfectly highlights the mood.
Okay.
Companies that beat their earnings estimates are seeing their stock price go up by only about 0.9%. That is well below the historical average.
So a polite golf clap, basically.
Barely even that.
Yeah.
But if you miss, or if you beat, but your guidance for the future is just a little bit weak,
What happens then?
the average drop is 4.0%. The punishment is severe. The market is just looking for reasons to sell right now, not reasons to buy.
So traders are just hovering over the sell button.
Just waiting for one wrong word.
Let's unpack that with the heavyweight, JP Morgan Chase. They reported this week. On paper, it looked pretty solid. They beat earnings per share $5.23 versus the expected $4.86. But the stock took a hit. Why?
It was fundamental, and it comes down to one phrase: expense shock.
Expense shock.
JP Morgan dropped an absolute bombshell in their guidance for 2026 expenses. They're projecting to spend $105 billion this year.
Wait, $105 billion? That's the GDP of a small country. Are they just burning cash?
It's not just keeping the lights on, it's the cost of staying relevant. Jamie Dimon is pouring money into technology, specifically AI, and the so-called talent war, paying top dollar to keep the best people.
And this just kills that operating leverage argument we've heard for years, doesn't it?
It pauses it, if not ends it. The idea that banks could grow revenue without growing costs at the same rate. That era of easy leverage is gone.
So the cost of doing business has just structurally shifted higher.
It has. And the market saw that $105 billion price tag and realized that profit margins are going to be under real pressure.
And there was another warning flag too, right? From both JP Morgan and Bank of America on net interest income, NII.
Right, their core business. The spread between what they make on loans and what they pay for deposits.
For the last couple of years, high rates were just a money printer for them.
A total money printer. But that gap is closing. JP Morgan guided for NII to be around $95 billion, which is basically flat. Bank of America guided for 5-7% growth, which sounds okay.
But investors wanted more.
It wanted more. The takeaway is that the windfall from high rates is fading. The free lunch is over, but the costs to run the bank are skyrocketing. That's a really tough squeeze.
So traditional banking is getting squeezed. But it wasn't all bad news in the financial sector, was it? Because if you looked at Wall Street deal-making, it seemed like a completely different story.
It's a tale of two banks, absolutely.
Hmm.
If you were a traditional lender, tough week. But if you're an investment banker, you're popping champagne.
And we're talking about Goldman Sachs here. They really showed up.
The star performer. Goldman posted earnings per share of $14.01, just crushing estimates by almost 20%.
Huh.
And the driver wasn't loans, it was fees.
What kind of fees?
Investment banking fees were up 25%. M&A advisory fees helping companies merge were up a massive 41%.
41%. Wow. We've been waiting for the deal freeze to thaw for, what, 2 years now? What does that tell us about the broader economy?
That's the key insight. CEOs do not buy other companies when they are terrified of a recession.
Right. It's a confidence game.
It is. This jump tells us the C-suite in corporate America believes the worst is behind us. They're confident enough to sign billion-dollar checks again.
And it wasn't just Goldman. Morgan Stanley had a really interesting quarter, too, but for different reasons.
They're becoming this massive asset gathering machine. They brought in $350 billion in net new assets for the year. It's just staggering.
Well, their model is less about interest rates and more about just managing wealth.
Exactly. It's a fee-based model, and in a bull market, money just flows in. It's a safer, better place to be right now than the interest-based model of lending. It's a lower risk revenue stream, and the market loves that.
So Wall Street is making deals, but what about Main Street? When we pivot to Wells Fargo, the story feels a little more gritty.
Wells Fargo is always a better proxy for the real economy, and yes, the warning lights are flashing there. They increased their provisions for credit losses to over $1 billion.
And provisions, just to be clear, that's money they're putting aside because they think a chunk of borrowers just won't pay them back.
It's a rainy day fund for bad debt. And the fact they're increasing it means they see storm clouds. They pointed to two areas: commercial real estate, which we knew was a problem.
In credit cards, that's the one that worries me. That's the average consumer.
It is. Delinquencies are rising. It's not a crisis yet. We're not in 2008 territory. But the trend line is going the wrong way.
Yeah.
And this ties perfectly into the sector data for the quarter.
You're talking about consumer discretionary.
Yes. The sector that sells things we want but don't strictly need, cars, luxury goods, travel, it's expected to see earnings contract by 3.5%.
So while the overall market is growing, the consumer is actually pulling back.
It tells us the U.S. consumer is prioritizing essentials. The high interest rates are finally biting. The pandemic savings are gone. If you're a retailer, this is going to be a very, very difficult season.
It really is that K-shaped recovery we always talk about. The high end is fine, but the average person is really tight in their belt.
The split economy, for sure, which kind of challenges that whole soft landing narrative.
Before we move on to the one sector that is basically holding up the entire market, and I think we all know which one that is, I want to take a quick pause and just ask a favor of our listeners.
Go for it.
If you like what you're hearing today, we'd love it if you'd subscribe to the channel, leave a like, and maybe comment on what topics you'd like us to tackle next. In the description, you'll also find a PayPal link in case you want to support this project.
Every little bit helps.
It really does. Your contribution helps us a lot to keep making content like this. We don't ask for more than the cost of a coffee. Thanks so much for your support.
We always appreciate it. It keeps the deep dives coming.
Okay, let's get back to the numbers. So banks are spending, the consumer is struggling, energy and industrials are also looking negative, but the S&P 500 is supposed to grow earnings by over 8%. Where's that growth coming from?
It's coming from one place, one massive engine. Information technology is projected to grow earnings by an incredible 25.9%.
26%. That's a huge divergence. The whole market is just becoming a tech ETF.
It really is the engine.
Yeah.
But I do want to flag one surprise winner that I think is interesting: the materials sector.
Materials, like mining and chemicals, that's a very old economy.
It is, but it's essential. It's projected to be the third best sector with 9% growth, driven by firm commodity prices like copper and gold. If you want a proxy for global economic activity that isn't a microchip, look at a company like Freeport-McMoRan.
They call copper Dr. Copper for a reason.
Because it has a PhD in economics. It's a little green shoot for the physical economy. But let's be honest, right now the market only cares about silicon. We have to talk about the Magnificent Seven.
Right.
Those 7 companies are expected to drive over 60% of the entire S&P 500's earnings growth this quarter.
60%. That concentration feels dangerous.
It's historic. Their earnings are expected to grow between 19 and 25%. But here's the scary part. If you take them out and look at the S&P 493, the other companies in the index, their earnings are expected to shrink.
So the soft landing narrative, it's really just the Magnificent Seven narrative. The average company is shrinking.
That is the risk. The market strength is masking some real underlying weakness. And that brings us to the most critical dynamic of this entire market, the AI CapEx cycle.
Right. This is the fuel. We talked about JP Morgan spending, but the tech giants are on another planet.
This is the ecosystem that matters. You have to visualize the flow of money like a water hose. On one side, you have the spenders: Microsoft, Meta, Google, Amazon. They are spending tens of billions on CapEx to build data centers.
And that hose of money flows directly to the beneficiaries.
To NVIDIA, to TSMC, to Applied Materials. One company's expense is another's revenue. The entire rally depends on that hose staying open.
But investors are getting nervous about the spenders, right? This idea of capex fatigue.
That is the multi-trillion-dollar question. All eyes are on Microsoft. They report at the end of the month. The question isn't, are you spending money? We know they are. The question is, where is the ROI?
The return on investment. Is this actually making money?
If Microsoft says we're spending $20 billion on AI, but growth in their cloud business, Azure slows down, the stock will get hammered. The patience for science projects is completely gone.
And Meta faces the same problem, maybe even more so.
Even more so. They have a history of spending big on the metaverse, which didn't pay off. Now it's AI. If their margins compress because spending outpaces ad revenue, it's going to be a very rough ride for them.
And the king of the beneficiaries, NVIDIA, they report much later.
Late February, they're the grand finale.
Yeah.
For them, it's all about the new Blackwell chip. That's the catalyst for 2026. Any delays, any supply chain issues, the whole market could catch a cold.
So looking ahead, this coming week and the next seem absolutely critical.
We call it the make or break period. Before the big tech giants, we get Netflix and Tesla from the 23rd to the 25th.
Netflix is a good check on the consumer. Are people still willing to pay?
Exactly. And Tesla is a check on the EV market.
Yeah.
But the main event is the week of January 28th. That is the heart of the season. Microsoft, Apple, Alphabet, Meta.
Let's touch on Apple. They've been quieter on the AI front.
Apple is tricky. The concern is China, where iPhone sales have been soft. Their services division keeps growing, but the question is, can it grow fast enough to offset a slowing hardware cycle?
They're walking a tightrope.
A very thin one. And for all of them, the bar is set at absolute perfection.
Which brings us back to where we started, that 22x PE ratio.
Decent results are not enough. They need to show accelerating growth. The market is projecting 15% earnings growth for 2026. Any hesitation in guidance?
And the stock crashes.
They get multiple compression. The PE in PE comes down to match reality, and it happens fast.
So to wrap this up, we're in a show-me market. The banks showed us costs are rising and the consumer is cracking. Now it's up to tech to show us that AI is actually profitable.
That's the summary. If the Magnificent Seven stumble, there is no safety net. The rest of the market, the S&P 493, isn't strong enough to carry the index.
It really makes you wonder. We keep hearing about the soft landing for the economy, but listening to this breakdown, is the soft landing actually just a tech landing?
That's the provocative thought to leave with. If you strip out AI and government spending, the cyclical economy looks a lot more fragile than the index suggests. We might already be in a recession for 490 companies, but the top 10 are just hiding it.
A lot to watch in the next 2 weeks. We'll be here to break it all down. And with that, we reach the end of today's episode. We hope you liked it, learned something new, and will join us for the next one.
Thank you very much, and we will meet again very soon.
Remember that the PayPal link is in the description if you want to help us. Thanks once again. Greetings.